Hello, and welcome back to Money Never Sleeps. My name is Bob Cruces from M&A Wealth. If you'd like more information about what you hear during the show, give us a call at 866-697-33627 or visit us online at mnawealth.com. And while at my website, click on the page to check out past shows and subscribe on Apple Podcasts or Spotify. During today's show, we're going to break down the rule of $1,000 in retirement. A Kiplinger article, The Rule of $1,000, Is This Retirement Rule Right for You?, provides some solid insight. Let's talk about a little rule with big impact, the $1,000 a month rule. Now, when it comes to retirement planning, you've got options. You can guess. You can toss out a nice round number like $1 million and hope it sticks. Or you can use a back-of-the-napkin formula that gives you a real starting point. Here's how it works. For every $1,000 a month you want in retirement income, you'll need to have about $240,000 saved up. That's based on something called the 5 and 5 rule, which uses a 5% return and a 5% withdrawal rate. So in general, if you want to pull $1,000 a month from your savings without draining the well, aim for $240,000. Want $4,000 a month? Multiply that by 4 and you're looking at $960,000. This rule isn't about perfection, it's about clarity. It gives you a target you can see, it turns the fuzzy future into something you can work toward right now because knowing your number is half the battle. And if you're working with an experienced financial services professional, even better. They can potentially turn that rule of thumb into a real dialed-in strategy that fits your life. Bottom line, don't fly blind. Retirement isn't a mystery, it's a math problem, and this one's got a pretty helpful shortcut. Let's further break down the $1,000 a month rule, because sometimes you just need a simple place to start. Retirement planning doesn't have to be complicated right out of the gate. Most of the time, you don't need a spreadsheet with 87 tabs or a PhD in economics. You just need a ballpark figure, a starting point. That's where the $1,000 a month rule comes in. Here's how it works. Step 1. Figure out what your monthly life is going to cost once you stop working. Think your rent or mortgage, food, gas, insurance, Netflix, golf, whatever you'll still be doing when the alarm clock is gone. Now let's say your number is $3,000 a month. Using the $1,000 a month rule, you'd multiply $240,000 by 3 and land at a nest egg of $720,000. Why? Because $240,000 generates about $1,000 a month in income, based on an assumption of 5% annual return and 5% withdrawal rate. It's not perfect math, but it's powerfully simple. And remember that your retirement income doesn't live on savings alone. You'll likely have help from Social Security, a pension, or an annuity that reduces the lift your savings needs to carry. But bear in mind that the rule isn't precise, not even close. It's a thumb on the scale estimate, but for younger savers looking for a long-term target, it's a great launch pad, something to shoot for while you're building momentum. For folks in their 50s or 60s though, you'll want a more dialed-in game plan, something custom to your life, your goals, and your timeline. That's where working with a financial services professional could make a difference. You've also probably heard of the 70% rule, which says you'll spend about 70% of your current after-tax income in retirement. So if you bring home $100,000 now, plan for around $70,000 per year, or about $5,800 a month when you retire. Some firms, according to the article, even suggest saving 10 times your income by age 67. Again, it's a ballpark, not a blueprint. Ultimately, the $1,000 a month rule won't get you all the way there, but it'll absolutely help you take the first step with confidence, and sometimes that's exactly what you need. The article next shares some of the rule's potential downsides. Let's talk about where the $1,000 a month rule falls short, because even good rules of thumb come with fine print. Like most quick retirement guesstimates, the $1,000 a month rule sounds simple, because it is. But simplicity doesn't always mean accuracy, and when we're talking about your financial future, it pays to look under the hood. One of the biggest red flags? The 5% withdrawal rate it's based on. That's on the high side. Most financial services professionals lean toward the more conservative 4% rule, or even 3%, to protect your nest egg and make sure it lasts through a 30-plus year retirement. The 4% rule says you withdraw 4% of your savings in year 1 and then adjust for inflation each year after. That's designed to keep your money working without burning through it too fast. The 5% rule, on the other hand, asks your portfolio to pull more weight, and that gets risky in low-return environments. If your portfolio is earning less than 5% a year, and recent projections from Vanguard shared in the article say it might, then you're eating into your principal every time you make a withdrawal. That's a recipe for running out of money, especially if you're relying heavily on stocks to hit those returns, and more stocks generally means more volatility. Now here's where the math gets real. To generate $1,000 per month with a 4% withdrawal rate, you need $300,000 saved, not $240,000. At 3%, you need $400,000. So yes, dialing back your withdrawal rate makes your income more sustainable, but it also means you need to save more upfront. And let's not forget, the $1,000 rule doesn't account for inflation. $1,000 today isn't going to buy the same lifestyle 15 or 20 years from now. Plus, if that money is sitting in a traditional 401k or IRA, you'll generally have to pay income taxes on every dollar you withdraw. So, if you're in the 22% tax bracket, that $1,000 turns into more like $780 in actual spending power. And the $1,000 rule doesn't come with a timeline. If your savings don't earn a return at all, that $240,000 lasts just 20 years, and more retirees are living well past that. If you ran the numbers and determined that $1,000 a month rule feels a little out of reach, don't sweat it. There are real, practical ways to close the gap. If your 401k or IRA balance isn't quite where you want it to be, you're not out of the game. Not even close. This is where strategy steps in. Step 1, turn up the savings. Even small increases now can potentially lead to a big difference later. And if you're in your 50s, you might be hitting your peak earning years, which is the perfect time to ramp things up and make up for lost ground future you will thank you. Step 2, catch up contributions. Once you hit 50, the IRS rules allow you to sock away more than the usual limits in your retirement accounts. In 2025, that extra boost is $7,500, and if you're between 60 and 63, you can pour in up to $11,250 in additional contributions. Remember, you're not stuck. You're just one decision away from getting back on track, and when you've got a clear plan and the right tools, whether it's your employer match, an annuity, or a financial pro in your corner, you're not just saving, you're building momentum. The $1,000 a month rule isn't useless, it's just not the whole story. You've got to start somewhere, and if you're just beginning to think about retirement, this rule gives you something to point your compass toward. That's valuable. But let's be honest, if you're 62 and wondering, can I actually retire now? You don't want to base that decision on a back-of-the-envelope guess. That's not strategy, that's just hoping for the best. At that stage, you need a plan built around you, your lifestyle, your goals, your income sources, and yes, even your what-ifs. A financial services professional won't just hand you a benchmark, they'll help you design a roadmap. Because when you're this close to retirement, it's not about rough estimates anymore. If you have any questions about your retirement magic number, your retirement strategy, or any other parts of your financial strategy, visit my website at mnawealth.com or call my office at 866-973-3627 to discuss how my team might be able to answer your questions and address your concerns. It's our goal to help you prepare for the retirement you've worked so hard for.
Disclosure. All matters discussed during the show are for informational purposes only. Opinions expressed are solely those of M&A Wealth and staff. All topics covered are believed to be from reliable sources. However, M&A Wealth makes no representations as to its accuracy or completeness. This commercial shall in no way be construed as a solicitation to sell securities or advisory services to residents where permitted. Topics should be discussed with your individual advisor prior to implementation. Advisory services offered through M&A Wealth, a registered investment advisor in the state of Texas. Insurance products and services are offered through PNC Life Insurance Agency, an affiliated company. M&A Wealth and PNC Life Insurance Agency are not affiliated with or endorsed by the Social Security Administration or any government agency.